There is a new technological institution that will fundamentally change how we exchange value, and it's called the blockchain.
What if you could own a piece of the Empire State Building for the cost of a Netflix subscription and trade it on your phone while waiting for coffee? Sounds like science fiction. And to be fair, we're not quite there yet. Right now, the deed to that building is still just a dusty PDF sitting in a county office buried in paperwork. If you tried to buy even a fraction of it the traditional way, you'd be looking at weeks of delays, big fees, and a small army of lawyers just to process the deal. But here's the shift that matters. A quiet tech upgrade is already starting to change this system. Instead of deeds trapped in filing cabinets, ownership is moving onto digital rails, cutting down on middlemen and making assets easier to split and trade. This isn't just theory. Dubai has launched a real estate tokenization pilot that lets investors hold fractional shares of property through blockchain. JP Morgan is building out platforms for tokenized assets and collateral, and tokenized gold is already trading in global markets, showing how physical assets can move into digital form. So here's the spoiler. The infrastructure is being built, and it's happening faster than most people realize. This isn't about meme coins or speculative hype. It's about reshaping how we buy, sell, and own the real world. I'm not here to pitch you a coin or a course. My goal is bigger. I want to show you why the phrase, "I'll send you the keys," is about to mean a string of code instead of a piece of metal, and how that shift could unlock trillions in wealth that's been frozen for decades. Assets once reserved for the super rich could soon be open to anyone with a smartphone and Wi-Fi. Here's what we'll cover today. First, the broken way we currently trade houses, art, and even music royalties. The endless delays, the hidden fees, and the deliberate roadblocks that lock regular people out. Second, the blockchain solution. Breaking down huge, hard-to-trade assets into digital building blocks anyone can buy, sell, or manage with a few taps. And third, the reality check, the legal headaches, technical risks, and yes, the greed factor that could derail everything if we're not careful. By the end, you'll see where the real opportunity is, how to separate the scams from the genuine breakthroughs, and why even BlackRock's CEO Larry Fink has called tokenization the next generation of markets. Think about the last time you bought or sold something big. A car, a house, maybe even a piece of art. You probably had to deal with a realtor, hire a lawyer, wait on an escrow company, and sign a mountain of paperwork. Then, on top of that, you paid a bunch of fees that felt way too high for what you actually got. The whole process is slow, confusing, and expensive. Almost like it was built to be that way. And honestly, it kind of is. The system is set up so every middleman they're cut while moving at a snail's pace. They keep things complicated on purpose, making it hard for regular people to get in. The result? Real estate, which is worth about $320 trillion worldwide, moves painfully slow. Homes sit on the market for months. Closings drag out for 45 days on average. And if you only have a few $1,000s to invest, you're shut out completely. The system keeps you outside the gate while the insiders cash in. It's not just housing either. New York taxi medallions, once seen as gold mines, are difficult and costly to trade. A painting might sit locked in a vault for decades, changing hands only through private deals between millionaires. Even music royalties from a hit 90s rap song are usually tied up in contracts that only big investors can access. The truth is, the whole setup is designed to keep wealth concentrated at the top. And that's exactly why blockchain matters, because it can break those walls down. Think of the old system like a giant overpriced candy bar. Only a few people could afford the whole thing. Blockchain changes that by slicing the bar into small, bite-sized squares that anyone can buy. Each slice is a token, which works like a digital deed. A clear, unbreakable record of ownership stored on the blockchain. And because the blockchain isn't controlled by any one company or government, it's secure, transparent, and nearly impossible to fake. That token could represent a tiny share of a Picasso painting, turning a $20 million artwork into something you can actually own a fraction of. Or it could represent one day's rent from a Miami condo, paying you a steady income. It could even represent a single dollar of a corporate bond, giving everyday people access to investments that normally only institutions can touch. No one can secretly change your record or steal your slice. Plus, it's programmable. That means rent can flow straight to your digital wallet the second it's paid. No waiting for accountants or middlemen. Smart contracts handle it automatically, fairly, and on time. And because the blockchain runs globally, someone in Tokyo can buy your fraction of that Picasso at 3 a.m. just as easily as your neighbor could. In short, assets that used to take weeks or months to trade suddenly behave like shares of Tesla stock. Fractional, easy to buy and sell, and available around the world. This opens the door to wealth-building opportunities that were once only for the super rich. And the technology that makes it possible. The same blockchain that powers Bitcoin, with all its security and reliability. The difference is, these tokens are backed by real-world assets, so you get the transparency and speed of crypto, but without the wild price swings. Tokenization rests on three key pillars. Think of them as the three legs of a stool, each one essential to the model. First, fractionalization. This is the ability to take a huge indivisible asset and split it into $1 million $10 tokens. For investors, it means regular people can finally buy into assets that were once off limits. For owners, it unlocks trapped value without forcing them to sell the entire thing. It democratizes access on one side and creates new capital-raising tools on the other. Second, liquidity in secondary markets. Once fractionalized, those tokens can trade on specialized markets, like a NASDAQ for everything. Instead of waiting months for a buyer, you could sell your slice of a property in minutes, even at 2 a.m., to someone across the globe. This constant global marketplace makes traditionally illiquid assets far more tradable and reduces the risk of being stuck holding them for too long. Third, smart contract automation. Smart contracts are code-based agreements that enforce themselves. The same system that mints your token can automatically handle rent splits, dividend payouts, or even group voting on property decisions. They cut down on paperwork, legal battles, and human error, replacing them with automatic, transparent execution that everyone can verify. Put together, these three legs don't just modernize finance. They build an entirely new asset class, one that's liquid, transparent, global, and open to anyone with a phone and internet connection. Real estate is one of the most valuable markets on Earth, but also one of the slowest and most outdated. That's why it's become the entry point for tokenization. Everyone understands rent or home ownership, so it's the perfect place to prove the model. And the revolution has already started. Take platforms like Lofty AI. With as little as around $50, you can buy a token that represents a fraction of a rental property. That token earns rental income paid straight into your digital wallet, and if you want to exit, you can list it on their secondary market and sometimes find a buyer in days. RealT uses a similar setup with Detroit properties, paying out weekly in USDC stablecoins. These aren't just experiments, they're working platforms giving regular investors access to cash flow and liquidity once reserved for the wealthy. Governments are testing it too. Dubai's land department has launched a pilot to tokenize property and integrate it with the city's land registry. The plan is to scale this through 2033, keeping blockchain records synced with official ownership records. That kind of legal backing lowers risk for investors and shows tokenization isn't just hype. It's being taken seriously at the highest levels, and even the big banks see the value. JP Morgan's Onyx division has been running blockchain pilots for assets like real estate funds, showing that trades can settle in hours instead of weeks and with lower costs. Multiply those efficiencies across trillions in property transactions, and the potential savings are enormous. Tokenized real estate isn't a far-off dream. It's here now, working at startup scale, being tested by governments and studied by Wall Street. Tokenization may sound like a golden ticket, but every new frontier has its shadows. And here's where things get messy. First, the law. In the US, the SEC still treats most tokens as securities. That means if you sell them without the right filings, you're basically selling unregistered stock. One wrong move, and you could be staring down fines and years of legal trouble. The reality is, only well-funded players can afford the lawyers and compliance teams to navigate this shifting landscape, while smaller projects struggle to survive. Then, there's the technology itself. Smart contracts, the very code that makes tokenization possible, can also become its greatest weakness. In 2022, a flaw in the wormhole protocol allowed hackers to drain $320 million in minutes. When the code breaks, the money doesn't just vanish, it's gone for good. That's why audits and bulletproof security are vital, because on the blockchain, mistakes are permanent. But even if the code is flawless, the numbers might not be. A token tied to a Miami condo bought at bubble prices is still just an overpriced condo. Tokenization doesn't magically protect you from bad fundamentals. If the asset loses value, the token sinks with it, leaving investors holding the digital equivalent of a very expensive pet rock. And finally, the oldest risk of all: greed. Bad actors can mint more tokens out of thin air, quietly dilute investors, or simply run off with the funds in what's known as a rug pull. Others don't need to be criminals to cause damage. They can just mismanage the asset into the ground. Blockchain automates trust in the system, but it doesn't automate honesty in people. You know something big is happening when the financial giants start circling. BlackRock, Fidelity, and Goldman Sachs. These aren't the type of firms that show up late unless they plan on running the whole show. BlackRock's CEO, Larry Fink, has already called tokenization the next evolution of capital markets. Here's what that means in plain English. The same firms that charge you 0.5% to hold an index fund will happily sell you a tokenized version at 0.3% and pocket the difference. They see the efficiency, the cost savings, and the billions in new revenue. This wave cuts both ways. On the upside, their arrival drags in trillions of dollars, legitimizes the tech, and makes the mainstream finally pay attention. If BlackRock launches a tokenized fund, your skeptical neighbor will suddenly care. Institutions bring credibility and scale that can speed up adoption dramatically. But there's a flip side. These giants will lobby for complex regulations that create moats, locking out smaller players. They'll say it's for investor protection, but in reality, it prices out independence and makes sure the most lucrative opportunities stay in their control. So where does that leave you? Right now is the sweet spot. The rules are still being written, the system is still flexible, and individuals who learn early can position themselves ahead of the machine. Wait too long, and you'll just be another customer paying their fees, playing by their rules. If this breakdown of fractional real estate and always-on wallets is starting to make sense, if you're seeing how this could open real opportunities, hit that like button. It costs you nothing, but it tells the algorithm to show this video to someone else who still thinks owning is impossible. It also helps me keep making videos like this. Appreciate the support. Let's jump ahead to 2030 and imagine what daily life could look like in a fully tokenized world. This isn't sci-fi. The pilots are already here. The only question is how fast it all rolls out. You wake up and check your digital wallet. Overnight, a commuter in Tokyo paid micro rent for a bullet train seat you partly own, and the payment landed instantly. As you sip your coffee, another notification arrives. Royalties from your fractional share of a Bob Dylan song streamed in from Spotify Brazil. Each payment is small, but together they're steady, constant, and fully automated. Later in the day, you rebalance your portfolio. You sell part of your stake in a Wyoming wind turbine, a transaction that clears in minutes. With that cash, you buy carbon credit tokens from a reforestation project in Kenya, an investment that's both profitable and environmentally positive. Because the credits are recorded on-chain, you know they're authentic. Before bed, you join a quick governance vote. This time, it's to help choose the lobby color for a Dubai skyscraper you invested in. Your vote matches the size of your stake, giving you a direct say in the property's future. Total time spent on your investments today, 10 minutes. Total fees, under $3. Blockchain isn't on the way, it's already here, turning assets into digital, tradable pieces anyone can own. The gatekeepers can adapt or get left behind. But for everyday people, this is a chance to finally step into wealth markets once reserved for the rich. Sure, there will be regulation, scams, and ups and downs. Every revolution has them. But the shift is unstoppable. Assets that once crawled now move at the speed of the internet. So here's your move. Test it for yourself. Start small, see rent hit your wallet in real time, or watch a fractional share of something bigger grow in value. Because when ownership becomes an app, the real risk isn't trying. It's being too late. And if you want to follow every twist of this shift, hit subscribe and tell me in the comments, what's the first asset you'd tokenize?